So the geopolitical world is in turmoil. Markets don't know what to do, and you're trying to make money. Let's talk about that. As I record this today, we have some excitement going on in Venezuela, in Greenland, in Europe, and markets aren't really sure what to do here. So I thought I would try to provide a little bit of clarity and show how this can be a learning experience and a very good reminder for investors. First of all, let's look at some current numbers. We see the ISM Manufacturing Index now at 4790. We really want that to be over 50. Virtually all the time. And another bit of bad news there is it has gone down from 4820 on the previous read. That gives us 9 straight months under 50. We need to keep our eyes on manufacturing, ISM manufacturing going forward here, because this is only going to get more and more important. The gross domestic product, the GDP numbers came in really, really strong, 4.3%. Now, as I always say, there are two sides to every trade. So there's nothing we can say to take away from 4.3%. That's what we want to see. On the other side of the ledger is the fact that there is some serious bifurcation going on right now. There are two different things happening. And I don't know that I have seen a larger difference between the health of the GDP and the stock market, and then also the real economy for most Americans. Some of what we're seeing here is called circular financing. You've probably heard about this. These, of course, are the AI build-out companies, people like NVIDIA and the rest, Microsoft and Meta and Google, who are essentially paying each other huge amounts of money as we build out the AI data center complex. Well, of course, that contributes to the GDP without necessarily being an accurate indicator of what the market is or what the overall economy is. We have to keep our eyes on that. Right now, we are dealing with what we would call a K-shaped economy. A K-shaped economy means that the high side of the K and the low side of the K represent the population. Most of the financial benefits of this economy are going towards the higher end of the economy. We'll see how that goes. Is this the new normal? Of course not. This may just be a situation that we're able to turn around before too long. And adding to the uncertainty now is the advent and the introduction of AI. And as this continues to become a larger part of the economy, perhaps we'll see things even out. Where we are right now is there. We have a basic K-shaped economy. I'm not making any predictions on where we're going to be 1 or 3 or 5 years down the road. This is the unemployment rate hanging at 4.4%. Generally speaking, that's okay. We've had layoffs in manufacturing and other areas, but at the same time, we have had layoffs due to AI. We've also had slowdowns in hiring due to both the AI build-out and the tariff situation. 4.4% ain't bad. I will take 4.4% for now. This is one that interests me, and this is the 10-year U.S. Treasury security yield. And if you take a look at this, right now we're at 4.17%. But the interesting part of this to me is the way we've gone pretty much sideways since late 2022. So that's about 3.5 years of essentially going sideways on this yield. So I don't think the bond market knows what it wants to do either. We'll see how that goes, but this will be something to watch going forward. One more thing I want to look at is a sector performance. If you look at the top performing sector for this year, and this is less than a month, we're seeing the industrials at about 7.58%. Now, the interesting thing here, and this is a learning experience for those who have not been down this investing road for too long, the S&P is up only 1.38. Well, why is that? Why can one part of the economy be up over 7% and the S&P way down at 1.38%? Well, the reason for that is the S&P 500 is a market cap weighted index. So the larger companies have a bigger influence on the S&P 500 numbers. So for an example here, the top 20 companies in the S&P represent about 50% of the index all by themselves. So 20 companies out of 500 represent 50% of the index. So then you look at the information technology sector where the biggest companies are, and it's down 0.57%. So it's fairly flat. That, though, tells you why the S&P is trailing the top sectors by so much. It depends on how much that sector is weighted in the overall S&P 500. Now, the market hates uncertainty. But I want to drill down to the next level, and that is corporations. Of course, corporations are at the heart of the market. That's where the equities are. So we have to look at what the corporations are having to deal with right now. And what I'm going to do here specifically is on tariffs. The thing here is whether it is a business, a large business, a small business, or even a family budget, we have to plan. And the difficulty that a lot of corporations have when tariffs are jumping around is they can't do general business planning. Participating in supply chains becomes more complicated for them because they might be in the middle of a supply chain, so they don't know how much they're going to be paying for their part of the supply chain before they pass it on to the next part. They have to do inventory planning. They have to do cash flow planning, forecasting, CapEx planning, and HR planning. So as I mentioned, what a lot of these companies are doing is they will have to lay off or they will have to freeze hiring in order to deal with the increased cost of these tariffs. So here's where America finds itself right now, and this battle is only getting worse. I'm not a particularly political individual, but I do have to keep this stuff in mind as I'm looking at the numbers. There are some things we know. It does not look like partisan politics is going anywhere, and it's going to happen. And for right now, I only see the split getting worse. And so we do have to deal with that. Another thing we know is capitalism 2.0 is going to continue. And capitalism 2.0, in my terminology, is a very active Fed. And that began with the 2008 meltdown and QE, and the Fed has just not stopped. So, the Fed is going to continue to jump in and out of markets or the economy to save us from ourselves. That's not going to change anytime soon. And I think that we can expect the unexpected to keep happening. This is a crazy time right now for us in early 2026. But this is not the only crazy time. And so an investor has to look at, well, what can I do? An investor has to protect themselves. And it's complicated enough trying to make money with investing before global macroeconomics and politics just make things worse. So what can an investor do? And I'm going to give you two ideas here, two general ideas. And this is nothing you don't know. I think the value of this is that it's a reminder. And sometimes when things get nuts, we have to remind ourselves of the basics. First of all, there's risk management. And in my humble opinion, risk management is even more important than picking a stock. Risk management now, though, when things are as goofy as they are right now, it only becomes more important. What does that include? Making sure that you have clear entries and exits. Understand why you're getting into a trade and how long you might want to stay in it and what is going to cause you to leave. Is it a technical indicator? Is it a stop out? Perhaps you have a 5% stop where you're going to get sold immediately if it drops 5%. Whatever it is, clear entries and exits are absolutely essential. Position sizing. If you put too high of a percentage of your portfolio at risk in one security, you are begging for trouble. Now, with more experienced investors, that becomes less of an issue. They will become more concentrated. But until then, we got to be careful. Non-correlation is very important. We'll talk about it here in a second. But to me, there's a difference between diversification and non-correlation. We'll get into that. But the main thing that we have to remember is discipline. And that is having a plan that works for us, a plan with which we are comfortable, and sticking to it, because the nuttier things get, the more difficult it is for us to remain disciplined. So that has to be a top priority as well. Times of uncertainty remind us that our overall strategies have to allow for volatility. Now, if you are sensitive to volatility, look for ways to comfortably diversify very quickly. When I was a financial advisor before I retired, one of the things that an advisor is going to do is they're going to ask you about your risk tolerance. And they're going to say, what would happen if the market dropped 10%? What would you do? Would you want to get out? Would you want to stay in? Would you want to adjust? Would you want to add because you're buying on the dip? We need to know that. I have found over the years that saying the market dropping 10% is not as effective and doesn't create as much focus as when we use dollar amounts. So let's say someone had $500,000 with me. Rather than say, what happens if the market dropped 10%? I would say, what happens if you lose $50,000 in the market? It's the same thing. But I'm telling you, that made a difference in the way they reacted. When I talked about actual dollars, I found that people might not be as tolerant of risk as they may think. So make sure your risk tolerance is appropriate for what you can handle. It's a crazy, crazy time. But there are a couple of ideas to keep you on the straight and narrow. Thanks. Talk to you soon.